Last time we dove into outdoor holding company. Today, though, we're setting our sights much, much higher. We're looking at Virgin Galactic Holdings, Inc. Now, this is the aerospace firm that's, pioneering consumer space travel. And frankly, it presents one of the most stark financial contradictions you'll find. It really does. The tension is, it's almost hard to believe. You've got this company with a market cap that's quite low, right? Around, $197 million? But then you contrast that with just massive, massive negative profitability. Think about this. The trailing 12-month income is negative $302 million. So the loss is actually bigger than the company's entire market value. And yet, and this is the kicker, they have a surprising amount of liquidity. So the big question, the one we really need to unpack is this. Is Virgin Galactic fundamentally undervalued? Does its, significant cash pile and unique tech position give it the runway it needs in this developmental industry? Or is the valuation just wildly overstated because the operational losses are so catastrophic and the revenue is, minimal and shrinking? I'll be arguing for the first case, focusing on that balance sheet strength and the long-term potential here.
And I'll be taking the counterpoint, focusing squarely on the operational reality today. My argument is that the current valuation is rooted in, frankly, past speculation, not present economic sustainability. And those cash reserves? They're just a timer counting down against a fundamentally flawed business model.
Okay, so my core argument is that the market's current view, it just doesn't properly price what Virgin Galactic is. It's not a standard service company yet. It's a developmental aerospace entity building completely proprietary tech and infrastructure. For a company at this stage, they're developing the new Delta spaceships, building a whole new manufacturing facility out in Arizona. The key things to watch are asset protection, balance sheet health, and whether they can complete that development. Short-term profit isn't really the right lens here. So let's look at the financial cushion they've built. Cash per share, it's impressive, $8.67. Now, compare that to the stock price around $3.42. That tells you the cash they hold is worth way more per share than the market values the entire company at. It's like the market is assigning a big negative value to the actual operations, pricing it like a high-risk call option on the cash itself. And the liquidity ratios back this up. The quick ratio, the current ratio, both very strong at 3.38. Then there's the enterprise value, about $180 million, which is lower than the market cap of $197 million. That difference, that's the net cash position right there on the balance sheet. EPS is negative $9.05 TTM. But that's the cost of building something completely new, not necessarily a sign it's doomed, at least not yet.
That feels like a pretty dangerous way to look at it. My core view is that the operational numbers are just so catastrophically bad. They don't just suggest the model's immature, they suggest it might be fundamentally broken. This isn't just about high startup costs. This feels more like a massive uncontrolled leak. Just look at these margins. Gross margin, negative 5,323%. Operating margin, it's almost comical if it weren't real, negative 18,967%. And the profit margin, negative 17,828%. We have to let those sink in. These aren't just bad margins. They suggest that for every single dollar of revenue they bring in, and remember, that was only $1.7 million TTM, they're spending exponentially more just on the direct costs. It raises serious questions about whether they can ever make money with their current service at their current prices. And this ties directly into the valuation problem. A price-to-sales ratio of 115.86, EV sales at 106.28, that's just completely detached from any recognizable economic reality. How does $1.7 million in annual sales justify a market cap close to $200 million? It doesn't, unless you're purely speculating. And the market history confirms this pain. The stock's down 96.6% over 3 years. That's not volatility. That's sustained long-term destruction of shareholder value built on, a failure to deliver operationally. And the market history confirms this pain.
You're right. The burn rate is alarming, no question. But we have to put it in context, right? This is foundational work. Building out a whole new aerospace capability isn't like scaling a software company. That cash cushion isn't just static, it buys the time necessary for the business model to mature. It's the bridge funding needed to get from these early, small-scale flights to the potentially much more efficient Delta fleet. We're likely talking about years of runway here, protecting them while they try to scale up. And look, even the recent Q2 2025 results, yeah, still a loss, but they did beat revenue estimates, however small.
I'm sorry, but I just don't buy that. That argument treats the cash like it's sitting safe in a vault, but it's clearly not. That $300 million TTM loss isn't theoretical. It's an annual drain actively shrinking that runway you mentioned. And more importantly, the company itself basically told us the cash isn't enough. Remember back in Q3 2024, they announced an at-the-market equity program? Starting an ATM program, that's management signaling pretty clearly, isn't it? They're saying, we need more cash and we're ready to dilute existing shareholders to get it. Let me tell you why. A $300 million annual loss against a market cap of just $197 million, that means the market shouldn't just be looking at the cash per share today, it should be pricing in the inevitable future dilution per share. You might think you're paying $3.42 for $8.67 in cash, but that $8.67 is leaking away fast because of the operations, forcing them to sell more stock, likely at depressed prices, just to keep the lights on. So that runway, it's probably shorter and definitely more expensive for shareholders than just looking at the balance sheet suggests.
But hold on, what's the alternative to dilution? Without that ATM program or some other funding, the alternative could very well be bankruptcy. The real question is whether the asset they're trying to build here, the capability for safe, repeatable commercial space tourism, justifies that cost of capital, justifies the dilution. Investors are essentially paying a premium for the option to be part of a market that, if they actually pull off this Delta scale-up, Virgin Galactic could dominate, at least initially. That high current ratio, it ensures they can handle their immediate debts while pouring everything into that one big goal.
Okay, let's talk about these valuation metrics again, specifically in light of the tiny sales figures. At what point does a price-to-sales ratio of, 115? Stop being a sort of it's a growth stock metric and start just signaling terminal illness. The total TTM revenue was $1.7 million. Okay, let's assume roughly $450,000 per ticket. That means they maybe flew 4 flights last year? Maybe? How does that possibly support a $197 million market cap? Even at a more reasonable PS ratio, say 10, they'd need to be generating like $20 million a year. Not $1.7 million. The current valuation implies they need to be making well over $1 million a day eventually, not per year. And it's not just that sales are low. They're actually shrinking dramatically. Sales year-over-year TTM were down 84%. That's not slow growth. That's revenue falling off a cliff, happening while their costs and R&D needs are still enormous. It shows the current service isn't scaling. It's barely operating. The core economic engine seems stalled.
That's an interesting point, though I would frame it differently. That analysis assumes the company's value is tied to its current, very limited operations. But I think we're valuing future potential, future flights, not past revenue. Virgin Galactic is fundamentally an IP and infrastructure play right now. So applying traditional revenue metrics before they even have their main product, the Delta fleet, ready, it's kind of useless, isn't it? We're valuing the technological moat they're trying to build, the fact they might actually complete that Arizona facility. Look at the beta. It's 2.24, highly volatile. That confirms the market gets this. It sees Virgin Galactic as a pure high-risk, high-reward play. The payoff isn't about squeezing a few more dollars out of the current setup. It's entirely dependent on achieving commercial scale with Delta. And honestly, the analyst consensus seems to lean this way too. The average target price is around $392, still above the current $342 price. It suggests that even the professionals see some underlying value in that future option, despite the ugly current numbers. The market volatility reflects that optionality. And speaking of professionals, institutional ownership gives us another signal. It stands at about 20.42%. Now, these are sophisticated investors, right? They understand the risks, they see the high beta, they know about the massive costs. But they're still holding, suggesting they believe the potential long-term technological payoff might actually outweigh all this present financial distress. Also, we need to be careful interpreting insider sales. Those recent Form 4s everyone points to, they show option exercises at zero cost. That's typically executives cashing in compensation they've already earned. It's not the same as panic selling shares they bought on the open market because they've lost faith.
It's a pretty important distinction, I think, when trying to gauge management's real belief.
Okay, fair point on the options versus open market sales. But let's distinguish between broad institutional holdings and specific management conviction. Yes, institutions hold about 20%, but insider ownership, it's really low, just 1.39%. For a company this size, facing these challenges, you'd maybe expect management to have more, skin in the game personally if they truly believed this cash pile and future monopoly narrative was secure. Where's the significant insider buying? And moreover, the best ideas emerge from rigorous challenge, and that 19% short float, that's a huge amount of the available stock being bet against the company. That's a significant chunk of the professional market actively challenging this entire framework. It acts as a major counterweight to the institutional ownership argument. That high short interest, especially when you see some analysts issuing warnings, it suggests a large part of the market thinks this isn't just a risky bet, but maybe a fundamentally flawed one doomed to buckle under its own costs. Essentially, the market is betting the dilution risk, the need to keep selling shares, wins out before the Delta fleet ever becomes a reality.
So Virgin Galactic, it really remains this unique, almost idiosyncratic investment. The balance sheet health, especially that 8.67 cash per share, is the main pillar supporting it against these really alarming short-term operational losses, that negative $302 million TTM income. The whole investment thesis, I think, it just boils down to timing. Can they translate that cash into a working, scalable, profitable aerospace operation before the money runs out or before dilution makes the share price almost irrelevant? It's a real high-stakes race between cash burn and potentially revolutionary deployment.
These extreme negative margins, nearly negative 19,000% operating margin, combined with that completely unrealistic price-to-sales ratio, they strongly suggest the basic economics of the business might be inherently broken, not just temporarily stressed. Right now, the company looks like a highly speculative vehicle that's just consuming cash incredibly fast. The history of shareholder wealth destruction and the ongoing need for dilution seem to back that up.